Today, we're going to answer the question, what is a bear market and how can you survive a bear market? But first, my name is Kevin Lum. I'm a certified financial planner based in Los Angeles, and this is a new channel called Retirement Made Simple. Our goal is to make sure that everyone has access to the knowledge they need to retire without worry. And if this information is helpful to you, I'd really appreciate if you'd share it with your friends and your family. Click the like button, click subscribe, ding that bell, leave a comment, ask a question. All of that helps us to get the word out. Now, as a reminder, nothing I say is financial advice. I'm a financial advisor, but I'm not your financial advisor. So let's dive in. First, what is a bear market? So in markets, there are cycles that are measured from peak to trough. So stock market index, that all the research we'll use today will be for the S&P 500, reaches bear market territory when the closing price drops at least 20% from its most recent high. Whereas a correction, you'll hear people sometimes refer to the market as in correction territory, is when there is a drop of 10% to 19.9%. These numbers really aren't that important, but they kind of give us a benchmark to kind of measure against whether we're in a correction territory or bear market territory. So a bear market territory just means that the index, most commonly the index people refer to as the S&P 500, is that the index has dropped by 20% from its most recent high. A bull market, on the other hand, when a new bull market begins, is when the price gains 20%, the closing price gains 20% from its most recent low. But here's the thing, bear markets are normal. There have been 26 bear markets in the S&P 500 since 1928. Now, there have also been 28 bull markets, and stocks have risen significantly over that time period, somewhere around 10% annualized. So even though there have been 26 bear markets and 27 bear markets, if you'd held stocks during that time period, you would have made a lot of money. But bear markets are scary, and you have all these people on CNBC, banging gongs and talking, and it's just kind of a scary thing to go through. And so some of you may be asking, well, how low can it go? If we're in a bear market, how low can the market drop, or how low does it drop on average during a bear market? And the answer is, on average, when we're in a bear market, the stock market drops by about 36%. The good news is when we're in a bull market, the market gains about 114%, but that doesn't make it any more fun during a bear market period. So some of you may be asking, if a bear market drops by about 36%, how long can it last? And this is what's interesting. Bear markets actually are fairly short on average. The average length of a bear market is slightly under a year. If you want an exact number, the average is 289 days, or about 10 months. And that's significantly shorter than the average bull market, which lasts nearly 3 years, or about 1,000 days. Now, one of the things I found really interesting when I was doing this research is that this is, a bear market seems, every time it happens, it seems like it kind of takes us by surprise and it's kind of shocking. But actually, it happens about every 3.5 years. Or if you take the average since 1928, the S&P 500 has entered into bear market territory about every 3.5 years, which I thought was kind of interesting. Now, part of why this particular bear market, or the past couple, if you want to include COVID, feels so kind of jarring is we just ended one of the longest bull markets in history. Now, actually, the longest bull market was December 1987 through the dot-com crash in March of 2000. But the reason I say technically is because 3 years into that bull market run, there was a drop of 19.9 in 1990. So it wasn't quite a bull market, but we had, or a bear market, but it got really close. But over the past, 20 to 30 years, nearing 30 plus years, we've had 2 really long bull market runs. And so when we have one of these bear markets, it feels shocking, but actually it's good for the market to have a drawdown. It's healthy for the market. And actually a drawdown can help us to continue to rise in a more healthy manner. Now, here's something really interesting I found as well. I tend to go down rabbit holes. One of my friends said we should call this channel Down the Financial Rabbit Hole. But bear markets have been less frequent since World War II. Between 1928 and 1945, there were 12 bear markets, or one about every year and a half. But since 1945, there have been only 14 bear markets, or one a little over every 5 years. So currently, our bull markets are lasting longer, significantly longer than our bear markets. So up to now, you've learned that during a bear market, we can sometimes drop by an average 36%. And on average, it can last a year. Sometimes it's lasted longer, lasted a couple years, but on average, it's going to last about a year. So some of you may be asking, so how do I survive? And the answer is you just want to stay invested. Don't make any changes to your portfolio and ride the wave. If you need money to live on, maybe pull out a couple of years' living expenses, and then don't look at your portfolio, because if you do, it will just cause you to be depressed, cause you to have whiplash, and maybe do something you'll regret later. I remember during the COVID crash, I had a friend call me and she said, I'm down 40%, but I stopped the bleeding. I sold everything. I lost 40% of my money, but at least I can't lose any more money. And of course, we all know that if she just stayed invested, she would have had gigantic gains. But she didn't know that at the time and kept checking her portfolio and got overwhelmed. So just stop looking at your portfolio. Make sure you have enough money to survive, even if it's a long bear market, and then just let your portfolio ride. In fact, it's probably a good idea, if you are really concerned, to talk to a financial advisor so they can look at what's in your portfolio, make sure it's appropriate for where you're at in your stage of life, and then just to forget it until we're back to another bull market. So some of you are probably asking right about now, okay, if we can drop 36% on average in a bear market, and we're only I don't know what the exact number is right about now, but we're not near that. We haven't gone down that far. Some of you are saying, well, then should I sell? Why in the world would I stay? The problem is that half of the S&P 500 strongest days in the last 20 years have occurred during a bear market. And another 34% of the market's best days took place in the first 2 months of a bull market. But the problem was we didn't realize we were in a bull market. And so trying to time the market can just be incredibly difficult. And if you go back and look at backtest, if you try to time the market, you find out that you often end up reducing your returns, because markets are forward-looking instruments. They're looking towards the future. And so if you're focused on the present and you're like, wow, things are really bad now, I should sell, the markets are looking to the future and they can see that, better days are on the other side. Markets will begin to rise before things have really felt settled. And so it's best not to try to time the market and to just stay invested. In other words, the best way to weather a downturn is just to stay invested, even though it's difficult, and wait for the market to recover. And assuming a 50-year time horizon. So let's say, you're invested in the market for 50 years, you start in your early 20s and you stay invested. I mean, for many of us, it could be 60 to 70 years of an investment time horizon from when we begin investing to when we pass. You can expect to live through about 14 bear markets. So some of you are on your third or fourth. The good news, the bad news is you could have a few more of these before your time on Earth is over. So although it can be difficult to watch your portfolio dip with the market, it's important to keep in mind that markets have downturns. It's just part of the process. It's always happened. And although it can be painful, overall markets are positive a majority of the time. And so I'm going to leave you some positive words of hope. During the last 90 years, so from 1928 till today, bear markets have comprised a little over 20 years. So out of 90 plus years, a little over 20 years, slightly under 21 years have been bear markets. Put another way though, stocks have been up 78% of the time. And when they're up almost 2 to 1 the times that they're down. And so if you just stay invested, you're going to be okay. Create a balanced equity portfolio, have it diversified, globally diversified, and then just let the markets do what the markets are going to do. If you're still not convinced, or you're a little nervous, or maybe you're not sure if you have a globally diversified portfolio or a balanced equity portfolio, and you want to talk to someone, I will put a link to my website where you can schedule a call in the comments or in the show notes. And then also, once again, if this content was helpful, if you would like and share. And then also we've created a private Facebook group for retirees or people nearing retirement or thinking about retirement called the Retirement Tax and Income Forum. It's a private group where you can share ideas, ask questions. I'll be in there answering questions. And so we would love to have you join that group. Again, thanks for watching the Retirement Made Simple, and share this with your friends.